Ever wondered if Wall Street speaks a different language? It often feels that way, right?
Definitely.
What if we explored the idea that sometimes on Wall Street, buy really means hold, and maybe hold often means sell?
It's like this hidden code.
Exactly, like deciphering a secret code. And if you don't know it, you're playing by completely different rules.
Mm-hmm.
So today, we're diving deep into those hidden meanings, behind investment recommendations and also the psychological traps that can snare even seasoned investors.
Yeah, it's easy to fall into them.
Our source material kicks off with a really relatable story, actually. The author's very first investment.
Oh, the first one. Always memorable.
Totally. A sure thing tip,
Yeah.
apparently from a friend's secretary, some rumor about a buyout. He plunged in $10,000.
Ouch. 10,000 on a rumor.
Yeah. And then he was calling the automated phone system like every hour as the stock just plummeted.
I can just picture that sinking feeling.
Right. 3 weeks later, he sells it for $6,000, just feeling that absolute gut punch of regret. He even told his wife, "My hunger was gone," just completely lost his appetite over it.
Wow. Well, that author's story, it isn't unique, sadly. It's a pretty common path, I think, from pure speculation towards hopefully informed investing.
Hopefully being the key word there.
Exactly. It really underscores that critical distinction. Are you speculating, basically gambling on gut feelings, or are you actually investing like a business owner, focusing on data, fundamentals for long-term success?
That's the goal, isn't it?
That's the goal. So today we want to help you recognize these early, often really expensive missteps and learn from others' lessons to build your own solid investment approach.
And those first mistakes, they often seem to pave the way for even bigger challenges down the road.
It can, yeah.
I mean, the author's second investment journey, for instance, sounds even rougher. He lost $30,000 on broker recommendations. That included options, too.
Options are tricky, very easy to lose big.
He describes this pattern, kind of like you see in gambling, taking longer breaks after big losses, but then getting almost cavalier after wins,
Right, feeling overconfident.
which just makes you more vulnerable.
Yeah.
And this isn't just anecdotal. It's actually backed by William Sharpe's Nobel Prize research. It shows how risk aversion can actually decrease after wins, leading to these exaggerated market behaviors.
Yeah, that makes sense. The psychology is powerful.
But it's not just our internal psychology, is it? Think about external bad advice, like his neighbor, Jack. Apparently, his entire investment strategy revolved around buying stocks at a lower price than his disliked in-laws.
Seriously, that was his strategy.
Yeah, he bragged, like, "My mother-in-law just got AOL for $49 and I got it for $46. Often led to big losses, of course. But Jack seemed more concerned with, quote, ruining their day than actually making money.
Wow. That's quite something. But it's compelling, isn't it, how universal these human tendencies are? We see this herd mentality, this peer pressure playing out everywhere.
Like high school, but with money.
Pretty much. The dot-com bubble is such a classic illustration. You had VCs pouring millions into companies with barely any sales.
Right. Brick and mortar was suddenly a dirty word.
Exactly. And valuations based on, what, pad views? Or other totally speculative metrics. Even Warren Buffett, was being reviled as a has-been for sticking to his value investing principles.
It's easy to forget that now.
It is. And our author himself got caught up. He invested in a company called PSINet, only to lose it all when the company filed for bankruptcy, just swept up in that same frenzy.
And it wasn't just, anonymous people on message boards pushing these stocks. The guru phenomenon absolutely exploded then.
Oh, yeah, the TV personalities.
Right. Jim Cramer, for example. He was confidently pushing the Street.com stock when it was around $5. It eventually dropped to $1.25.
Ooh.
He even started this $39 a month email service promising subscribers they could trade virtually, along with Cramer.
Follow the leader.
Yeah.
Right off a cliff sometimes.
Yeah. And then you had outright pump and dump schemes. There's that wild story of the 15-year-old Jonathan Labid
I remember that.
hyping these thinly traded microcap stocks on Yahoo message boards with completely fabricated predictions just so he could sell his shares for a quick profit when others piled in.
It just really highlights this crucial question for all of us, doesn't it? If you can't always trust friends or neighbors or even these prominent financial gurus, well, how reliable is the advice that's out there? And what are the hidden agendas?
That idea of trust, yeah, that's so critical. Because when it comes to Wall Street, that trust can often be Well, misplaced. There's definitely a hidden language going on, a code we need to figure out.
At the translation guide.
Exactly. Analysts, surprisingly perhaps, don't always say what they really mean. Our sources actually lay out a pretty clear code book.
Okay, let's hear it.
So strong buy generally means buy. That one's fairly straightforward.
Okay, got it.
But buy itself often actually means hold.
Interesting. So a buy isn't really a strong endorsement.
Apparently not. And then you get hold, neutral, market perform, or maintain, all of those variations.
Yeah.
They typically mean sell if you own the stock, and definitely stay away if you don't.
So hold is actually a negative signal.
Pretty much. And actual sell recommendations almost never happen. Less than 1% during the crazy 90s boom.
Wow, less than 1%. That's telling.
It is. A stark example. Piper Jaffray downgraded Dell and Intel from strong buy down to just buy back in 2000.
Okay, so just one notch down.
Right. But that wasn't a signal to just hold on tight. It was actually a clear warning sign of further decline. And sure enough, both stocks plummeted even more after that downgrade.
So the why behind all this sort of code, it really comes down to Wall Street's inherent conflict of interest, doesn't it?
Seems like it.
Analysts' pay, their bonuses, it's often tied directly to how much investment banking business their firm brings in.
The underwriting connection.
Exactly. So there's this massive incentive to be overly optimistic about companies their firm is underwriting or, wants to do business with later.
Makes sense. Keep the clients happy.
Precisely. You had high-profile analysts like Blodgett and Meeker, who became kind of notorious for pushing internet companies their employers were underwriting, often with disastrous results for individual investors who followed that advice.
I remember those names.
Yeah. This conflict got so blatant that the SEC finally stepped in and enacted Regulation Fair Disclosure, Reg FD.
Right, to level the playing field for information.
The goal was to combat that selective disclosure, to make sure all investors get important material information at the same time. But, even with regulations...
That's always a workaround.
Well, there's often a will to beat the system, right? There's always a way through maybe friendship and networking, as the source puts it. Peter Cyrus had this kind of provocative idea.
What was that?
Force analysts to invest their own bonuses in the stocks they cover.
Put your money where your mouth is, literally.
Exactly. Directly align their ratings with their own financial skin in the game.
Interesting idea. So, okay, what does all this mean for you, the individual investor listening right now?
Yeah, the practical takeaway.
It really means you need to build your own investment compass. You have to start by clearly distinguishing speculation from true business-like investing. The author shares this really compelling analogy from his time working at Chase Manhattan Bank's Credit Risk Management Group.
Okay.
They noticed this pattern. The more credit cards an individual held, the higher their risk of default.
Makes sense. Overextended.
Right. You can apply that same logic to investing. If a company is aggressively pursuing mergers and acquisitions one after another, it's kind of like that person with too many credit cards of a potential red flag.
That's a great analogy. And we can translate these kinds of corporate lessons into a set of, let's call them fundamental rules for investing.
Okay, let's hear the rules.
All right. First, true diversification. And I mean true diversification. It isn't just buying 5 different tech stocks.
Right, like spaghetti with different sauces, as the author says.
Yeah.
Still spaghetti.
Exactly. It means spreading your investments across genuinely different sectors, different types of securities, cash, bonds, stocks, and really aiming for what's called negative covariance.
Meaning things that tend to move in opposite directions.
Precisely. Where one asset tends to do well when another struggles, that smooths out your returns.
Okay, rule 1. True diversification. What's next?
Second, avoid margin accounts. Seriously, they're hugely profitable for brokerage houses. That's why they push them.
Because they charge interest, right?
Yes, and they magnify risk. For individual investors, margin can be like, quote, cancer eating away at your principal. It just magnifies losses dramatically when things go wrong.
Got it. Avoid margin. Rule 3.
Third, beware of IPO's initial public offerings. Individual investors, frankly, have very limited ability to make real money here.
Really? They seem so exciting.
They do. But often you're just part of a booster shot scheme that mainly benefits the insiders and the underwriters. Think about Palm. It soared on its IPO day, huge hype. A year later, down 90%.
Ouch. Okay, beware IPOs. Number 4.
Fourth, be wary of insider buying that seems maybe a bit too good to be true or too heavily promoted.
What do you mean? Isn't insider buying usually good?
Often, yes. But sometimes executives borrow money from the company itself to buy shares. This can be used to sort of incite investors, make things look good artificially. That tactic backfired spectacularly with companies like At Home and Net 2000.
Ah, okay. So check the source of the funds for insider buying. Makes sense. Number 5.
Fifth, aggressive mergers and acquisitions. We touched on this with the credit card analogy. These often destroy shareholder value for the acquiring company.
The company doing the buying often overpays.
Frequently. Lucent's disastrous $24 billion acquisition of Ascend is a stark warning. So if you happen to hold shares in a company that gets targeted for acquisition, consider selling when the deal is announced. The risk often outweighs the reward for the buyer.
Okay. M&A caution, Rule 6.
Sixth, something positive. Look for share buybacks. This is generally a strong positive signal.
Why is that?
Because when a company buys back its own stock, it reduces the supply of shares out there. This boosts earnings per share, and it signals management thinks the stock is undervalued. Cato Corporation saw a 70% return after buyback announcements. The author calls it the ultimate catalyst that spurs additional investigation.
Nice. A green flag for once. Number 7.
Seventh, beware of stock dividends. Not cash dividends, stock dividends.
What's wrong with those? More shares, right?
Well, they're often just functionally equivalent to a stock split. They dilute the value per share, and sometimes they can actually be a sign of underlying trouble, like watering down fine wine, as the source puts it. A company might do it if they're low on cash for a real dividend.
Interesting distinction. Okay, last rule.
Finally, and this is the most fundamental one, investigate before you invest. Do your homework. If the whole process of digging into financial statements doesn't excite you, or you don't have the time, seriously, consider just using a low-cost index fund.
That's really powerful, actionable advice. And that last point, investigate before you invest. Even simple tools can reveal some powerful truths, right?
Absolutely. You don't need a PhD in finance.
You can quickly get a feel for a company's financial health just by flagging positive P or negative N changes on its financial statements, like a basic directional progress report.
Yeah, track the trends.
Take Exodus Communications, which eventually went bankrupt. Looking back, it showed this significant imbalance. 16 negative flags versus only 8 positive flags on its balance sheet alone. A clear warning sign.
Well, a healthy company.
Exactly. Contrast that with IDEC Pharmaceuticals. Healthy company showed a clear majority of positive indicators on its income statement. It's not just about spotting red flags, it's understanding how early those signals often emerge, if you just look.
And beyond just the fundamental analysis, looking at the numbers, don't completely ignore technical analysis tools either.
Like charts and patterns.
Yeah, things like support and resistance levels or moving averages. They can be incredibly useful, especially for timing decisions. Consider the Enron example, total disaster.
Right. Wiped out completely.
If an investor had simply used a basic moving average system, say, selling when the stock price crossed below its 200-day moving average, it would have triggered a timely sell signal way before the final collapse. It would have significantly limited those devastating losses instead of just holding on until the bitter end.
So using different tools together gives a fuller picture. Fundamentals and technicals.
Precisely. Now, beyond looking at individual companies, it's also really crucial to zoom out a bit and understand how entire industries are interconnected.
Like the food chain of capital markets idea from the source.
Exactly that. Think of the Serengeti Plain. Grass feeds the zebra feeds the lion. But ultimately, even the lion depends on the health of the grass, right?
Okay, so how does that apply to stocks?
Well, think about the tech sector. Dell has a slowdown in PC sales. That directly impacts Intel, who makes the chips.
Yeah.
And if Intel slows down, that then impacts companies like Applied Materials, who make the equipment Intel uses to make the chips. See how they all move together? That's positive covariance.
Yeah, one domino knocks over the next.
You see it in the auto industry, too. Rising interest rates hurt car sales for manufacturers like Ford or GM. And if Ford and GM sell fewer cars, that then hurts their suppliers like TRW, who make the parts. It's all linked.
So understanding those links is key to diversification.
Absolutely. This is why true diversification emphasizes finding assets with negative covariance. Remember that. Things that move in opposite directions.
The umbrella maker and the tourist resort on the island.
That's the perfect hypothetical. When it rains, the umbrella maker thrives, the resort struggles, sun shines, the resort booms, umbrellas stay on the shelf. Overall, the island economy is more stable.
It's real-world examples.
Sure, Berkshire Hathaway Class A stock often moves differently than the overall NASDAQ index. They frequently diverge. Another really clear example is in personnel recruiting.
Okay.
During economic slowdowns, outplacement firms, the ones that help laid-off workers find new jobs, right, management consultants often see their business boom.
Right, unfortunately.
While at the same time, HR and recruiting firms focused on hiring new people, like admin staff, tend to suffer. Classic negative covariance.
That makes perfect sense.
Yes.
Any others?
Even counterintuitively, sometimes tragic events create these dynamics.
Mhm.
Look at the defense industry after 9/11. Companies involved in security screening, like Envision Technologies, saw their stocks soar because demand for their services skyrocketed.
Right. A grim example, but it illustrates the principle.
It does. Demographics play a role too. Think about the aging baby boomer generation impacting healthcare and even funeral home stocks.
Okay, so understanding these broader market dynamics, these food chains and covariances, is crucial. But let's circle back to that core problem, trust. Specifically, trusting analyst recommendations.
Yeah, where we started.
Dr. Dwayne Tway Jr. apparently defined trust as having three key components: our basic capacity to believe someone, our perception of their competence, and crucially, our perception of their intentions.
Intentions, right.
So if analysts' intentions are often, let's say, self-serving or tied to that investment banking relationship we talked about.
Then our trust in their competence, or at least their recommendations, naturally starts to erode, doesn't it?
Exactly. So what's a practical solution? The source suggests researching the research,
Meaning.
actually analyzing the historical performance of the financial institutions themselves and their recommendations. There are platforms now, like marketperform.com was mentioned, designed specifically for this. See who's actually been right over time.
Track records of the analysts and their firms. Smart.
Yeah. And doing this, researching the research, reveals some really powerful, actionable strategies based on how recommendations actually perform.
Okay, like what?
Take the artificial maturity date strategy. This applies to those strong buy recommendations. We know analysts are often late to downgrade. So if you just blindly follow a strong buy forever, you often underperform the market.
Right, they keep the rating too long.
But by setting your own selling point, an artificial maturity date, say 6 months or maybe 12 months after the strong buy is issued, you can often transform losers into winners.
Really, just by selling after a fixed time.
Yeah. The data is striking. A Bank of America strong buy on PC Connection, for example. If you sold it after 6 months, you'd have locked in 157% gain.
Wow.
But if you held it until BOFO eventually downgraded it, you'd have ended up with a 55% loss.
Huge difference.
Massive. Merrill Lynch strong buys showed a similar pattern. A 16.26% average gain if sold in 6 months versus only a 3.34% gain if held until the downgrade.
So the key takeaway there is analysts might be good at telling you what to buy.
But they're consistently too late telling you when to sell. So you need your own exit strategy.
Got it. Create your own sell discipline.
Which leads us kind of naturally to another really counterintuitive strategy,
Yeah.
the ugly ducklings approach.
Ugly ducklings.
This is when a sell recommendation, or more likely one of its euphemisms like hold, neutral, market perform, actually turns out to mean buy, but with a twist.
Okay, I'm intrigued. How does hold mean buy? Well, not immediately. The data shows if you buy a stock right on the day it gets slapped with a hold or market perform rating, you often lose money.
Okay, so the initial rating is bad news.
Right. Lehman Brothers market perform ratings, for instance, led to an average loss of 2.75% if you bought right away. Beauty. Here's the aha moment.
Yeah.
If you waited 1 year after that hold or market perform rating was issued before buying the stock,
Wait a year.
wait a year. Those same Lehman-rated stocks purchased a year later yielded a staggering average gain of 36.33%.
Whoa, that's huge. Why?
It outperforms 99.9% of professionals. It works by leveraging that powerful concept we keep coming back to, regression to the mean. Stocks that are beaten down often eventually recover. Waiting gives them time to bottom out and reduces your risk.
So you let the bad news wash out, then buy when nobody cares anymore.
Essentially, yes. You're buying pessimism after the initial shock has passed. Now, there's one crucial caveat here.
What's that?
Avoid doing this with hold-rated penny stocks. They often don't recover. Stick to more established companies that have just hit a rough patch.
Got it. No penny stock, ugly ducklings.
Yeah.
But that idea, regression to the mean, that really seems to be the powerful concept at the heart of so much of this, doesn't it?
It really is fundamental. Markets and individual stocks within them, they tend to revert back to their average performance levels over time. High flyers eventually cool off. Beaten down stocks often recover.
And this is where behavioral finance comes in too, right? Showing how investors own overreactions driven by greed when things are hot or fear when they're not actually create these opportunities.
Exactly. Legendary investor Bill Miller, for example, had huge success with his Legg Mason Value Trust, partly by consistently buying what looked like undervalued mistakes, companies others had panicked and sold off too cheaply. He knew those overreactions would likely correct eventually.
Even the Enron catastrophe we mentioned, it highlights this too.
How so?
Well, basic fundamental analysis would have raised red flags way earlier. And even if you missed those, simply applying that artificial maturity date strategy selling within, say, 12 months of any initial strong buy ratings would have protected most investors from the final wipeout, regardless of analysts sticking to those positive ratings for too long.
Right. Having sell rules protects you.
So the core actionable advice really boils down to a few key things. Real diversification, definitely avoiding margin accounts, and probably most IPOs. Embracing regression to the mean by patiently investing in those ugly ducklings, the delayed hold purchases.
Letting time be your ally.
And crucially, selling the growth stocks after their big strong buy run, using those disciplined artificial maturity dates instead of waiting for the analyst to tell you it's too late.
That really sums up a practical approach based on this research. In closing, maybe I can offer just one final thought for contemplation. It builds on this idea of long-term perspective and patience.
Please do.
Aaron Nimzovich, who is a renowned chess philosopher and master,
Just
he observed that a professional chess player is often satisfied with just achieving a slightly better position on the board, maybe even just a small pawn advantage they can nurture over time.
right, playing the long game.
Exactly. Whereas a beginner, they're always looking for that instant killer combination, that checkmate in 3 moves.
I see the parallel.
It applies so directly to investing. Professional investors, they're often quite exuberant if they manage to beat the S&P 500 index by even a small margin consistently. Amateur investors, meanwhile, are frequently looking to retire on just 1 or 2 massive stock picks.
Chasing that killer combination. It reminds me actually of that Pink Floyd lyric quoted in the source material.
Which one was that?
And you run to catch up with the sun, but it's sinking and racing around to come up behind you again.
That's perfect. So the
Yeah.
message is, don't endlessly chase those high-flying stocks that have already had their huge run-up, the ones catching the sun right now.
Because it's already sinking for them.
It might be. Instead, try to become the patient investor. Be willing to wait, because inevitably, many of those same stocks, or others like them, after they've fallen back to earth, they'll come up behind you again, offering another, perhaps better, chance later on.